The man who broke the bank. In 1992, George Soros executed a $10 billion bet that shattered the British pound, earning $1 billion in a single day. He didn't use insider trading. He used a powerful philosophical idea called reflexivity. This is the story of how a Holocaust survivor became the most feared financial speculator in history, who used his money to fund a global political war and challenge the sovereignty of nations. This is the code of financial warfare, survival, philosophy, and the genesis of reflexivity, 1930-1969. George Soros, born Georgi Schwartz in Budapest, Hungary in 1930, stands as one of the most enigmatic and feared figures in modern finance and global politics. His immense wealth was not built on innovation, trade, or long-term investment, but on the intellectual application of a single, powerful philosophical idea, the theory of reflexivity. Soros's formative lesson in power and strategy came not in a classroom, but under the brutal totalitarian regimes of the 1940s. At the age of 14, he survived the Nazi occupation of Hungary, a period where his Jewish family was forced to constantly change identities and hide. This required a relentless strategic deception that demanded he continuously assess and predict the flawed perceptions and intentions of the powerful oppressors. An early practical education in reading human bias. This experience, surviving by seeing the world not as it should be, but as the powerful perceived it to be, became the crucible for his later financial genius. After the war, Soros emigrated to London, where his intellectual foundation was solidified at the London School of Economics under the influential philosopher Karl Popper. Popper's work centered on the concept of the open society, a political ideal where freedom of thought and democratic institutions allow society to critically self-correct. This ideology, born from Soros's trauma under the Nazis, became the guiding mission of his vast philanthropic network decades later. More importantly for his financial career, Soros applied Popper's critique of scientific certainty to economic markets, creating his cornerstone strategic tool, the theory of reflexivity. The first cardinal lesson of the Soros Code is recognizing that markets are inherently flawed and driven by human bias. Reflexivity challenges the established economic doctrine of rational expectations and market efficiency. Soros posited that the participants' perceptions and expectations about the market's fundamentals are not passive, but active and causal. The market's perception, e.g., the housing market is stable, drives decisions, e.g., people buy more houses, which changes the objective fundamentals, e.g., prices rise unsustainably, which then reinforces the initial flawed perception, a self-reinforcing feedback loop. This creates financial bubbles, crises, and herd behavior, periods of extreme disequilibrium that rational, efficiency-focused investors ignore. Soros realized that true wealth lay in identifying these self-reinforcing loops. Understanding the precise moment the flaw, the bubble, would become clear, and strategically betting against the herd. This transformed finance from a science of data into an art of psychological warfare and prediction. After a decade of unsatisfying conventional work in London and New York finance, where he found that conventional wisdom was often wrong, Soros decided to apply his philosophical framework directly to high-stakes speculation. In 1969, he co-founded the Quantum Fund, a revolutionary vehicle designed to execute his contrarian, aggressive, and highly leveraged strategic bets on currencies, commodities, and stocks around the world. He was no longer content to simply observe the flawed market. He was now moving to actively exploit the systemic mistakes that were being ignored by the vast majority of the financial world. The transition from philosopher to financial titan was complete.
The Quantum Fund and the Code of High-Stakes Leverage, 1969-1989. The Quantum Fund, co-founded by George Soros in 1969, was the perfect operational vessel for executing the theory of reflexivity. It was structured as an offshore hedge fund, a crucial factor in the Soros Code of Power, as it allowed two key strategic advantages unavailable to traditional investment vehicles. Firstly, the hedge fund structure allowed for unlimited leverage, borrowing vast sums of money to amplify potential gains or losses. This turned every successful bet into a massive, market-moving victory. Secondly, it granted the fund complete global freedom to speculate on any asset, currencies, bonds, commodities, or stocks, unconstrained by national regulations. The second cardinal rule of the Soros Code was established. To achieve exceptional returns, one must be willing to take exceptional, leveraged risk on a global scale. The Quantum Fund did not engage in traditional stock picking. Its strategy was global macro. This involved identifying major, overarching economic or political shifts, such as a government's pending currency devaluation, the collapse of a commodity price, or an unsustainable bubble in an entire national market, and placing huge leveraged bets on the outcome. This required not just financial analysis, but the ability to forecast geopolitical instability and governmental strategic error, a constant application of reflexivity. Crucially, Soros recognized that success was less about being right and more about risk management. He famously stated, "It's not whether you are right or wrong, but how much money you make when you're right, and how little you lose when you're wrong." This psychological trait was unique. While most investors anchor themselves to their initial analysis, Soros actively searched for flaws in his own thinking. If a trade went against him even slightly, he was willing to exit immediately and admit error, protecting the fund's capital. His willingness to be wrong protected his overall capital, ensuring that the few times he was monumentally right, when reflexivity took hold and the market moved violently, the massive leverage would deliver world-shaking profits. This strategy was tested and validated by the Black Monday crash in 1987, the most devastating stock market decline since the Great Depression. Leading up to the crash, Soros, applying reflexivity, recognized the self-reinforcing bubble created by irrational exuberance and lax regulation. He correctly began scaling back his exposure to the market, sensing the impending panic that would prove the market's assumptions were flawed. When the crash hit, the Quantum Fund made massive profits from the ensuing chaos. However, the final crucial step demonstrated his genius. After the crash, central banks, like the Federal Reserve, began intervening aggressively to prop up the system. While others remained bearish, betting on further decline, Soros correctly forecast that the irrational perception of stability, fueled by central bank intervention, would quickly rebound the market. He quickly reversed course, betting on the recovery, thereby profiting not just from the crash, but also from the subsequent, central bank-driven irrational correction. The 1987 crisis confirmed the validity of reflexivity in the modern, centrally managed economy. It transitioned Soros from a successful speculator into a financial force who could read the instability of entire systems, preparing him for the legendary bet that would define his legacy and shatter a European nation.
The target, the exchange rate mechanism, and the flaw in the British pound, 1989-1992. After demonstrating the predictive power of reflexivity during the 1987 crash, George Soros turned his focus to the largest and most unstable financial system in the world, the unified currencies of Europe. He was searching for a massive structural flaw, a powerful economic policy based on a flawed political premise. He found his target in the exchange rate mechanism, ERM. The ERM, established by European nations, was designed to stabilize currencies by requiring member nations to peg their exchange rates within a very narrow band, primarily against the mighty German Deutschmark, DM. The goal was to eliminate instability before the eventual launch of a single European currency. Britain, seeking economic respectability, joined the ERM in 1990, fixing the value of the pound sterling high against the DM. This strategic commitment was based entirely on political will and the perception of stability, and it contained the fatal flaw that Soros identified. The flaw was a brutal and fundamental economic contradiction. To keep the value of the pound pegged so high against the DM, the Bank of England, BOE, was forced to maintain extremely high domestic interest rates. These high rates theoretically kept foreign investors interested in holding the pound. However, these high rates were simultaneously devastating the British domestic economy, driving the nation into a deep and painful recession, inflating unemployment, and strangling business investment. The third cardinal lesson of the Soros Code was now clear. When political commitment forces economic fundamentals into an unsustainable contradiction, the political commitment must eventually break. Soros's application of reflexivity was precise. He calculated that the market's perception that the government could maintain the peg was fundamentally flawed by the economic reality, the recession. He knew that as speculators began to sell the pound, the government would be forced to spend billions buying it back to maintain the peg. This action was financially finite. The more the government spent, the more speculators would bet against them. Realizing the government's resources were limited, a massive, self-reinforcing reflexive loop that guaranteed collapse. Over a period of several months in 1992, the Quantum Fund meticulously executed the Code of Secrecy. Soros, working closely with his chief strategist Stanley Druckenmiller, quietly and systematically built up an enormous short position against the pound sterling, borrowing billions of pounds from banks and immediately selling them for Deutschmarks, betting that he could buy the pounds back later at a drastically reduced price. The scale of the preparation was gargantuan. The Quantum Fund, along with its aligned investors, amassed a combined short position that eventually reached an estimated $10 billion against the British currency, a wager unprecedented in its size. The entire strategy hinged on the conviction that the philosophical insight of reflexivity was a more powerful force than the political ambition of one of the world's oldest central banks. Soros was ready to challenge the will of an entire nation on a single strategic flaw.
Black Wednesday and the $1 billion bet, September 16, 1992. By the morning of Wednesday, September 16, 1992, a day forever known in British financial history as Black Wednesday, the stage was set for the ultimate showdown between George Soros's financial conviction and the political will of the British state. The atmosphere was electric with mounting pressure. Smaller speculators, noticing the fundamental contradiction in the pound's position, had already begun selling, forcing the Bank of England, BOE, to expend billions from its foreign currency reserves simply to buy pounds and maintain the ERM peg. The fourth cardinal rule of the Soros Code was put to the test. A speculative attack, when based on fundamental economic truth, will always defeat political pride. Soros, seeing the BOE's reserves rapidly draining, judged that the moment of maximum vulnerability had arrived. He unleashed the full, calculated might of the Quantum Fund, executing his $10 billion short position against the pound in a sustained, overwhelming surge of selling. This massive volume of sales pushed the pound's value relentlessly downward, driving it past the critical ERM floor and into dangerous territory. The Bank of England panicked. Their initial response was to frantically spend more currency reserves. It is estimated that over $15 billion of British and European reserves were spent that day in a desperate attempt to defend the peg. When this failed to stabilize the currency, the BOE resorted to the ultimate desperate maneuver to try and attract investors. They dramatically announced a massive, sudden increase in the base interest rate, first from 10% to 12% in the morning, and then a shocking promise of a hike to 15% by the afternoon. This was intended to signal resolve, but Soros and his team correctly understood that the move would only accelerate the reflexive loop and confirm the government's terror. The higher the interest rates climbed, the more speculators and ordinary traders realized two critical facts. One, the government was in a state of chaos and financial distress. And two, these extreme rates would guarantee the deepening of the already severe recession, making the pound's long-term position even more unsustainable. The interest rate hike, intended as a defense, functioned as a self-inflicted wound. The market's perception of the government's stability evaporated, fueling the massive sell-off. By 4 p.m. that afternoon, the BOE conceded defeat. The Chancellor of the Exchequer, Norman Lamont, made the humiliating announcement that the UK was immediately suspending its membership in the ERM. The peg was broken. The pound sterling instantly plunged in value, validating every single bet placed by Soros and his allies. In a single 24-hour period, George Soros's Quantum Fund realized an estimated profit of over $1 billion from the trade, instantly cementing his status as the most powerful and feared financial speculator in the world. He had successfully applied philosophy and strategic leverage to overwhelm the financial defenses of a major world economy.
The Global Financial Predator and the Pivot to Open Society, 1992-1997, the billion-dollar victory over the Bank of England in 1992 did more than just fill the Quantum Fund's coffers. It dramatically magnified George Soros's strategic leverage. His sheer size and demonstrated conviction created a new, powerful tool, the Soros effect. The fifth cardinal rule of the Soros Code was now operational. Your reputation for ruthlessness becomes a self-fulfilling prophecy. When the market even suspected that Soros was shorting a currency, other speculators and banks would immediately join the attack, turning his prediction into an instant reality, a massive, accelerated application of reflexivity. Soros immediately leveraged this new reputation, moving quickly to target other politically committed but economically fragile European currencies. He rapidly shorted the Italian lira, the Spanish peseta, and the Portuguese escudo, securing substantial gains and proving his strategic agility. By the mid-1990s, Soros shifted his gaze to a far more volatile and lucrative target: the burgeoning Asian tiger economies, specifically Thailand, Indonesia, and Malaysia. These nations were experiencing explosive growth, but Soros identified the now familiar fatal flaw. They had pegged their currencies, like the Thai baht, to the stable US dollar, yet they were simultaneously taking on vast amounts of short-term, US dollar-denominated debt to fuel infrastructure projects. This created a severe contradiction. If the local currency were forced to devalue, the debt burden, which had to be repaid in expensive US dollars, would instantly bankrupt thousands of businesses, a massive, unstable reflexivity loop built on the perception of stable exchange rates. While Soros was quietly positioning the Quantum Fund for this potentially catastrophic financial attack, he was simultaneously executing the second, complementary element of his personal code: the massive expansion of the Open Society Foundations, OSF. Soros began pouring billions of dollars into Eastern Europe and the former Soviet Union, funding initiatives to promote democracy, transparency, education, and human rights. For Soros, the goal was philosophical: to actively implement the principles of Karl Popper's Open Society and dismantle the vestiges of the totalitarianism he had survived. This duality, the active pursuit of colossal profits through market instability and the massive funding of humanitarian and political stability, created the central, most intense controversy surrounding Soros. Critics argued that he was operating as a financial predator, destabilizing national economies, like the UK and later Asian nations, for profit, only to then use those profits to fund political NGOs that meddled in the internal affairs of those same nations. The defense articulated by Soros himself was that he was simply exploiting the flaws inherent in the system, flaws created by governments committed to false, unsustainable policies, like a rigid currency peg. In this view, his financial actions were merely exposing a necessary truth, and his philanthropy was a moral duty to fix the political disorder that his financial insights revealed. This contradiction, destroying market structures to reveal flaws and funding political structures to promote stability, is the most complex, defining lesson of the Soros Code of Power, preparing the stage for his final, massive financial conquest in Asia.
The Asian Hurricane and the Crisis of National Sovereignty, 1997. The year 1997 marked the climax of George Soros's application of the Code of Reflexivity on a global scale, culminating in the Asian financial crisis, a systemic economic collapse that plunged millions into poverty and ignited a fierce debate about the sovereignty of nations versus the unchecked power of global capital. Soros, recognizing that the currency pegs of the rapidly growing Thai baht and its neighbors were fundamentally unsustainable due to massive, short-term foreign debt, began positioning the Quantum Fund for a decisive attack. The final, brutal lesson of the Soros Code was delivered. The flaw exposed by a financial attack will cause vastly more damage than the attack itself. In the spring of 1997, the speculative pressure against the Thai baht reached its breaking point. Thailand's central bank spent billions of its limited foreign currency reserves trying to defend the peg, pouring money into a structurally failed system, a desperate defense that Soros's team calculated would only speed up the inevitable. In July 1997, the government surrendered, forced to float the baht, abandon the peg. The baht instantly collapsed, triggering a massive, self-reinforcing panic known as contagion. Investors across the globe instantly recognized that the same structural flaw, fixed currency pegs combined with unsustainable US dollar-denominated debt, existed in virtually every tiger economy, including Indonesia, South Korea, and Malaysia. Money poured out of the entire region at terrifying speed. The currencies of these nations lost between 30% and 80% of their value in months. Stock markets plunged, and the dollar-denominated debt became impossible to repay, leading to mass bankruptcies, political turmoil, and widespread human suffering. The scale of the destruction, estimated in the hundreds of billions of dollars, was a direct consequence of the reflexive loop that Soros had identified years earlier. This crisis was not merely financial, it was geopolitical. Unlike the attack on the distant British pound, the Asian crisis triggered immediate, intense backlash from national leaders who blamed Soros directly for the destruction of their economies. The most outspoken figure was Mahathir Mohamad, the Prime Minister of Malaysia, who publicly and repeatedly condemned Soros as a moron, a villain, and a criminal, accusing him and other hedge funds of deliberately sabotaging developing nations for profit, viewing the crisis as an attack on national sovereignty itself. This confrontation perfectly encapsulated the duality of the Soros Code, a system where an individual's philosophical insight and financial conviction could hold the stability of entire continents hostage. Soros maintained his consistent defense. He was not a destroyer, but a messenger. The crisis was caused by the government's poor, corrupt, and ultimately flawed policies. He simply had the foresight to exploit the resulting disequilibrium. Regardless of his moral intent, the consequence was clear. Soros had proven that in the modern interconnected global system, financial strategy, leverage, and the strategic exploitation of flaws were the ultimate destabilizing form of global power.
The transition to Megadonor and the enduring legacy, 1997 present. Following the Asian financial crisis, George Soros stood at the apex of global financial power. However, his financial reign, built on agility and large-scale leveraged bets, was approaching its natural end. The final strategic pivot of the Soros Code was determined by a single paradoxical factor. The quantum fund had become too big. By the late 1990s, the fund's size exceeding $20 billion hindered the flexibility needed for the type of rapid, opportunistic macro bets that defined Soros's success. If the fund bought or sold a currency, the move itself became a market event, reducing the efficiency of the trade. The sixth cardinal lesson of the Soros Code was enforced. Know when the engine that created your fortune has become an anchor. Over the next decade, Soros slowly began to wind down the fund's external operations, eventually converting the massive hedge fund into a private family office in 2011, returning billions to external investors. The era of the most powerful speculative vehicle in history had formally ended. With the end of his full-time trading career, Soros fully transitioned into his second equally controversial role, a political megadonor and global activist. His focus shifted entirely to the Open Society Foundations, OSF, pouring billions of dollars into political and social causes worldwide, using his wealth to actively shape geopolitical outcomes, the ultimate application of his money-making strategy. In the United States, he became a central, divisive figure, spending hundreds of millions on progressive political causes, funding local prosecutors, and fiercely opposing political figures he deemed a threat to democratic institutions. Globally, the OSF became a target of authoritarian regimes. In Russia and his native Hungary, governments accused Soros of orchestrating political instability and foreign interference, forcing the OSF to close operations in several countries. This opposition perfectly highlights the enduring controversy of the Soros Code. His critics see his philanthropic efforts as the final political step in a scheme where wealth created from market instability is used to fund political instability, disguised as altruism. In his final legacy, Soros confirmed the profound influence of his philosophy. The theory of reflexivity, the idea that markets are driven by psychological bias and self-reinforcing flaws, is now taught in business schools worldwide, having permanently discredited the naive doctrine of pure market efficiency. Soros proved that strategic insight, coupled with radical leverage and the willingness to take asymmetric risks, could grant a single individual the power to reshape national economies and challenge sovereign governments. The George Soros Code is the final modern lesson in power, a synthesis of extreme financial conviction and philosophical commitment, demonstrating that in the 21st century, intellectual strategy and centralized capital are the ultimate decisive weapons.